Guess who we get to hear from this week, guys? It is all of our favorite person, Fed Jerome Powell. Yes, he will be speaking on Wednesday, the same day that we start our spree of economic data releases, which will start on Wednesday through Friday. And each of these days will have big data points, which we will go over here in this video. Now, nonetheless, I think it's pretty safe to say that we will see something similar that we just got at the FOMC press conference, where the initial statement was very dovish, talking about cumulative monetary tightening and the lags that you will see with that, and how the Fed should essentially slow down the pace of rate increases. And then Fed Jerome Powell came out and completely trashed the markets. He was saying, yeah, no way in hell are we going to slow down raising rates until we see substantial progress on inflation, and that the terminal rate might be much higher than what we previously thought with the last SEP, Summary of Economic Projections from the Fed, that we got back in September. So it was a real bombshell to the markets. But ever since the CPI report came out, the markets have reacted very, very positively. Now, we're going to talk about all of that, and I think that will be very important. We also have some Black Friday numbers that just came out, which is showing a little bit of economic softening, which is a positive thing for the markets, guys. So let's get into it. The only thing that I ask you to do is hit that like button. It helps the channel out tremendously, and subscribe to the channel if you guys make it to the end of this video and you like the information that is provided to you. Now, let's get to it. Let's first start with the economic calendar from the Federal Reserve website. And November 30th, that is on Wednesday, Fed Jerome Powell will be speaking at 1:30 p.m. on the economic outlook, inflation, and the labor market. And let's just summarize this for you guys, because I could honestly talk a half an hour on exactly what Fed Jerome Powell is going to say. But long story short, I think we are all in unanimous agreement. It's probably going to be some very bearish speaking. And from my perspective here, what Fed Jerome Powell said at the last FOMC press conference was the terminal rate is going to be higher, and that's what the markets really care about, but we have not gotten an actual number. The last SEP report that we got, Summary of Economic Projections, where you get the dot plot and you get all the estimates from Fed members, the average consensus was for 4.6% terminal funds rate, and the terminal rate means, you know, the Fed's going to keep raising rates until they get to that rate, and then they're going to stop raising rates. Well, we thought it was 4.6%. Now markets are expecting 5.25% at the higher end range after the FOMC press conference that we just got. But what if it's higher than that? What if Fed Jerome Powell gives us a number of 5.5 to 6, or even 6.5 to 7%? Well, that is going to spell a lot of pain for the stock market. And this moment in time is kind of similar to Jackson Hole, where back in the summertime, you have the Jackson Hole Economic Symposium, and it's just a fancy word of saying an economic conference for world, Federal Reserve leaders to talk about economic policy. Well, the stock market had rallied fiercely heading into that, and that was basically a green light for Fed Jerome Powell to be very hawkish and to set the market straight, because after all, they don't want to cause financial instability. They don't want the markets to fall 50% if they don't have to see that happen, which I don't think they think that needs to happen. But when the markets rally 16% from the lows, like we have just seen, there's a lot of wiggle room for Fed Jerome Powell to come out and be very hawkish. And after all, when financial conditions ease, like we have been seeing, like bond yields going down and stocks going up, it does statistically cause people to spend more money, and that could cause persistently high inflation for longer. So it's actually part of, in a weird way, the Fed's mandate to keep the stock market down, at least until inflation comes back down to a reasonable level. So I do expect to get a lot of very hawkish things coming from Fed Jerome Powell, and what makes it very interesting is we're not going to have a lot of economic data until Wednesday. We're really not going to have anything that is important before Wednesday that could actually move the market. So if we do take a look at Monday and Tuesday, you don't have anything as far as economic data that will move the markets. You do have the S&P Case Shiller home price month over month and year over year for September. That can be important for obviously certain stocks, Home Depot, Lowe's, your real estate type of companies, but by and large, it's not going to move the stock market. Now, on Wednesday, that's where you start to get some important data points coming out, but not really the big ones for this week. So Fed Jerome Powell, he's kind of going to give us a hawkish statement before we could potentially get hawkish economic data as well, or bearish economic data. But at 9:15 a.m. on Wednesday, you do have the ADP employment change for November. At 9:30 a.m., 15 minutes after that, you do have the GDP growth rate quarter over quarter, second quarter, the third estimate. And then that's pretty much it. You're going to have core PCE prices as well, quarter over quarter, coming out at 9:30 in the morning. That will also be very important. And then at 11 a.m., you have the JOLTS job openings. We are expecting 10.4 million job openings. Last reading we got last month was 10.71 million job openings. So if this comes down in a big way, it's going to be very good. If the job openings go up, well, that is going to be very negative. You do have pending home sales month over month for October, pending home sales year over year, JOLTS job quits for October as well. All of those coming out at 11 o'clock in the morning. And that's basically it for Wednesday. And then on Thursday, you have personal spending month over month for October. We are expecting a 0.4% increase. Last month, we got 0.6% increase. That was the actual number. The forecast was for 0.7% of an increase. So we actually had positive, well, I should say it's negative economic data because people are not spending as much money, but it's positive for the stock market, right? Hopefully that makes some sense. So that is a little bit encouraging, and I think by and large, people are spending less money. Personal income month over month for October is expected to come out at 0.3%. The last month you came out at 0.4%. That was the same as the consensus. Now, those data points coming out at 9:30 in the morning. And then you have core PCE price index month over month for October and core PCE price index year over year for October as well, coming out at 9:30 in the morning on Thursday. You are expecting a 4.9% year over year reading. The last reading we got was for at 5.1%. So you are expecting that to come down in a pretty big way. The month over month, you're expecting 0.5% of an increase. Last month, that's the same as what you got, was a 0.5% increase. The consensus was for 0.3%. So last month, that was very, very negative. And then you have ISM manufacturing PMI for November coming out at 11 o'clock in the morning. That's probably not going to move the markets as much. Not a huge deal. But the big data point for this next upcoming week is going to be the unemployment rate for November coming out at 9:30 in the morning on Friday. You're expecting 3.7% unemployment. Last month, you were expecting the number to come in at 3.8% unemployment, and it came in at 3.7%. So we're basically expecting a flat unemployment rate. We're not really expecting, the unemployment rate to go up at all. So that leads me a little bit more to the bullish side because maybe you can see unemployment go up a little bit, and that would be very, very bullish. But until it happens, until we get to Friday, I'm not going to hold my hat on it, guys. Non-farm payrolls for November. We are expecting 210,000 new jobs that were added. Last month, you had 261,000 jobs that were added, and the consensus was for 200,000 jobs. So you massively beat that last month, and you are expecting a little bit more for this month or for last month than you were for 2 months ago, right? Hopefully that makes a little bit of sense, but you are expecting 210,000 jobs to be added for the month of November. So that's basically it. You have the average hourly earnings, participation rate, average hourly earnings year over year, manufacturing payrolls, average weekly hours. But overall, these are secondary catalysts, and the big data point will be the unemployment rate as well as just Fed Jerome Powell overall. He is going to definitely shake up the markets heading into these data points and probably going to make these data points much more important themselves after what Fed Jerome Powell is going to say. Now, as far as Black Friday sales, online sales topped $9 billion in a new record, and it says consumers spent a record $9.12 billion during online shopping Black Friday this year, according to Adobe. Overall, online sales for Black Friday were up 2.3% year over year, and that's the important number, 2.3% year over year. If you look at this article, right here, the headline says Black Friday means deep discounts for shoppers and intense pressure from retailers. People were expecting, or I shouldn't say people, the National Retail Federation is predicting a 6 to 8% increase in sales, including the boost from nearly record high levels of inflation. You only seen a 2.3% boost on online shopping. I doubt the actual number is going to be in between 6 and 8%. That can mean a very bullish thing for the market starting off the week, because you're not seeing as many people going out and shopping as what the expectations were, right? It was still 2.3% gain year over year, but if you're expecting 6 to 8%, well, that number, that 2% number, looks a lot better to actually fighting inflation. And with all of these deep discounts that we are seeing, they're likely to last for a while, and it might actually mean that the inflation rate could look really, really good for the month of November. So also do keep that in mind. The stock market over in Israel has closed trading, and they do trade on Sundays before our markets open, and their stocks are down almost 1% for the TA35. So just a little bit of an indicator of what could be coming to start off this week. Now, it wouldn't surprise me to see an overall muted Monday and Tuesday, just because you don't have economic data. People are going to be positioning for the Fed and that economic data, but it doesn't tend to lead to massive days in the stock market. But yet again, we have rallied 16% from the lows. That could mean a little bit more downside possibly for Monday or Tuesday. Now, let's take a look at how hedge funds are actually positioning their portfolios, because a lot of these guys have more information than us. Obviously, they know things that we just don't know because they have access to information that we just don't know. And for this next Friday's expiration, out of the total open interest sitting on the option chain, 31.61% of that open interest is calls. 68.39% is put. So it's obviously weighted to the put side, but a lot of these puts have been on the option chain for so long. I want to see if the actual open interest for puts continues to go higher in this week based off of new option orders being placed, because as you guys can see from kind of the live interesting options flow, a lot of these options have been calls as of recently, and some of these calls, you know, getting pretty high up there. The 410 strike, the 405 strike, you're sitting at 402.20 on the S&P 500. So you are getting up there with some of these calls, and a lot of these puts have just been on the option chain for so long, they've probably already long been hedged for if they were in the money. So you could see a lot of bearish positioning over the next week. If you even look out to the next big option expiration for the markets, the puts is sitting at 54.1%, calls is sitting at 45.9% for December 16th. So I think that will also be another very big option expiration to pay attention to starting the week on Monday and Tuesday, where hedge funds are putting their bets to the put side or to the call side. It looks almost 50-50 as of right now, only a 4% difference between puts and calls. So if that number does become wider, it might give you a good indication of how hedge funds are feeling for the next couple of weeks. Now, let's take a look at some of the technicals on the S&P 500, because I think technicals are important, and that is a lot of trading algorithms trade off of technicals, right? So if you get to these technical levels and you either find support, find resistance, or you break out above those key support resistance levels with overall trends, it can lead you to make some decent money. You're basically trading with the algorithms that are computer driven. About 80% of the volume on the markets on any given day is done with trading algorithms. So that's not with a tinfoil hat. That's literally a statistical fact. Now, if you look at what I have had drawn out for a while now, I don't like to change this up at all. I like to keep what I have on the chart so I can come back, refresh, and see how the trends are actually playing out. And from what I've had drawn out for a while now, you were either going to get that break down below this ascending level of support that we have drawn right here, and I put this on about in this range where you were coming down and flirting with it after you had already seen a 10% rally in the S&P from the lows. And what happened? You bounced above that, above the descending level of resistance line, and you've seen a strong close above that. So from the technical perspective here, it looks like the S&P could be in for some more rally to the upside. But with these data points and these catalysts and Fed Jerome Powell on Wednesday, it's going to make things a little bit interesting. I don't think you're going to get that full breakout to that 420 or 430 level, at least until we do get these catalysts out of the way. If these catalysts are a lot more dovish than expectations, that is going to be good, and that is what could give you the ultimate move to the upside. We're sitting right at about the 200-day moving average as well. If you break out above the 200-day moving average, that always is a change of trend. So if you break out above that, you are now in a bullish uptrend, like a firm bullish uptrend, and it's hard to say that this would be a bear market bounce, right? You would have to start talking about potentially this is the lows of 2022, in which I don't necessarily believe that is the case as of right now. So if you pull up these moving averages like I just did as well, you want to see if we fall back to the 100-day moving average at 390. That would be a $12 drop from now, so that would already be a pretty bad week if that were to happen. And if you were to find support at that level, if you do not and you break under that, you're going to break under this line that I just talked about, this level, this ascending level of support that we have seen ever since the lows, and that was back here on October 13th. So if you break under this trend line, that is going to mean potentially you're bound for new lows in the markets. And I think it depends on what Fed Jerome Powell says with the terminal rate. I think that is the thing the markets are concerned with the most. And we just did get a death cross, right? The 50-day moving average did just break under the 100-day moving average as well not too long ago. So that's obviously not a good thing, and you want to watch to see how these technical levels do react. If you guys want to put this same technical charting on your charts as well, just pause the video and relay exactly what is done. I think this is the best technical window, call it, to be watching for really over the next week. I think you're going to get a confirmation or a confirmation to the downside over this next week based off of these technicals, guys. So that is it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next.